Our latest Strategizer publication was just released and showed more of the same, but with some new wrinkles. The momentum, sentiment, and valuations have remained so extreme that the scorecard for the S&P 500 remained right near the floor at plus 3, and that is plus 3 out of a maximum reading of plus 100. In other words, we have no intention of chasing the rally, keeping in mind that the Strategizer model predicts forward returns on a 12-month basis. And those future returns have already been gobbled up by this last powerful leg to fresh highs. Canada and Europe, well, equity markets there, much cheaper, firmly in neutral territory, but no region commands as positive a future return potential profile than emerging Asia, where the scorecard was little changed at 70. It is firmly in bullish terrain as the region trades at multiples that touched off the secular bull market in the United States back in August 1982. Just like the US equity market is today, our corporate credit model is now flashing amber with super tight spreads failing to compensate for looming default risks. The scorecard here dipped to 37.6 from 39.4 last month and simply is not a compelling proposition. As for the maligned Treasury market, the yield back up and the sudden reset back to a higher for longer Fed has caused the Strategizer scorecard here to improve a touch over the past month to 40.2 from 37.3. A 40.2 reading for Treasuries isn't necessarily a pound the fist on the table buy recommendation, but relative to the meager plus 3 reading for the S&P 500, all I can say is that in the land of the blind, the one-eyed man is king, and the Treasury market does offer significant value relative to the S&P 500, a different way of saying that the equity risk premium remains far too low for our liking, as in a near 3 standard deviation event. Curiously enough, even with the US dollar strength and the economic woes in China, the commodity space has cheapened up so much that our commodity scorecard improved sharply in January. It went to 84.9 from 76 in December and 69.5 in November. So the message is to take profits in US equities and corporate credit, deploy the proceeds in stock markets in emerging Asia, commodities, and move gingerly to add some duration to the Treasury bond portfolio.